China has a population of over 1.4 billion people, compared to the US, which has 325 million. Around 18.5% of the entire world population lives on China's landmass. As far as China's economy goes, its GDP is presently growing at 6.8% per annum and has an unemployment rate of only 3.9%. Compare this with Australia. Our GDP is growing by only 2.4% per annum, and unemployment presently sits at around 5.5%. On current projections, Asia as a collective group of countries is forecast to account for 43% of world GDP by 2025. This will leave the US a reduced slice of the pie at 16.8% and Europe 17%. In 2017, US GDP was around 19.36 trillion US dollars, compared to China's of around 11.94 trillion. Based on present estimates, it's projected that by as early as 2022, China's GDP will rise to 18.38 trillion, compared to the US at 23 trillion. So by 2030, China's economy will likely surpass that of the US. So what does all this mean from an investment standpoint? In May this year, Alex Jamieson attended the world's leading CFA Institute conference in Hong Kong, where 1,500 of the world's leading asset management professionals gathered to hear the latest insights into the global investment marketplace. And it's wonderful that he's back here and he's joining us today. Welcome, Alex.
Thanks, Greg.
Let's start with your biggest takeaway from the conference.
I think it's when you think about the financial markets, you think about, New York with the US, you might think about London with their market and Japan as being really the largest sort of markets out there in the marketplace. We often forget about what Asia is, and particularly with China and the sheer size of this market. That was probably the biggest thing. You look at, say, the US, its market cap is about $27 trillion. Japan is about $5 trillion, and London's about $3 trillion. If I bring in China, it is a $10 trillion market if you include Hong Kong as well. And I think it, particularly when you read the press and everything and a lot of research, you're often looking at those other markets and in a lot of regards overlooking what's happening with China and with Hong Kong as a financial hub. And I think it's very exciting. We can see some of the opportunities within that market too.
Okay, so you mentioned Hong Kong. That was under British rule for, 156 years. It reverted to China on the 1st of July 1997. Apparently, we're on the doorstep of another massive fundamental change in China's equity markets. Can you explain that?
Yeah, so there's two big changes that are happening, and the first one is on the 1st of June. And this sounds absurd. I just gave you the market cap numbers, so China's no small market. On the 1st of June, the MSCI index, which a lot of fund managers, super fund providers, pension fund providers, they'll use that as a benchmark reference. So they'll organise the companies that they own to match that benchmark. On the 1st of June this year, they're looking at including around 280 shares of China's, what they call their A-class shares in the MSCI. Now, the thing with that is, if we think about foreign ownership in China, in the US, it's about 20 to 30% of their market is owned by foreign owners. In China, it's only about 2.5% of the total market is owned by foreign owners. And so essentially you're going to see a huge opening up of the Chinese market for, I guess, these investment managers that I mentioned, but the percentage is tiny. They're only looking at putting an allocation of about 2%. Now, you've spoken about how big the population is. You've spoken about how huge their GDP is. You must at some point sort of reflect and go, is 2% a good weighting for such a ginormous market, or can we see that to be quite a larger representation over time?
I've been told that 2014 was really important for China. How did this change the equity markets forever?
It was a sounding of the bell for private equity. It wasn't so much for the mum and dad's investor, but it was the sounding of the bell for private equity. In late 2014, Alibaba was listed, which is a huge China tech company. It has a market cap of about $230 billion. If I give you some context, CBA is only about 123, so it's about double the size of CBA. It's an Amazon company, and it was the first, I guess, most significant private equity listing. Now, what that did is that basically everyone up until that point were focusing on Silicon Valley. You know, what is the latest and hottest tech company? And it made the private equity market take note. And then you saw huge inflows of capital via private equity institutions investing into China tech. So it was certainly a game changer.
All right, moving to venture capital, private equity, what's happening in those areas of the market?
I think with private equity, a lot of the focus has been historically in Silicon Valley. If we look at deal flow and who were the largest buyers of companies, so a lot of people come to us and say, Alex, I want to get in on the ground floor of the next Amazon or Google. The reality with a lot of this is they're going to these providers well before the mum and dads get access to it. So in 2017, Google acquired close to 107 companies in one calendar year. It was the largest acquirer of companies. The interesting thing though, number 2 spot is not a US company. The number 2 spot actually was for a company called Tencent, which is a China tech company. They're kind of a social media company, and they were not too far behind. They were really significant sort of numbers that I think it was like 72 companies they acquired. The number 3 position, you would think, oh, surely that's going to be a US company. No, it was actually a Japanese company called SoftBank. Now, they held number 3. Interestingly, they've actually been involved with investments into companies like Uber that you may be familiar. Now, if you look at the other component, Unicorns, which is a private company that hasn't listed yet but has a market cap of about $1 billion, the top 10 companies globally, so examples of that would be Airbnb, not yet listed. Everyone wants it to list, but they're not. Uber is another one, not yet listed. Everyone's particularly interested. In the top 10 companies, 4 spots of those are held by Chinese companies. The balance is held by US companies. So we can certainly see, I guess, that interest and that scale that's happening through that market.
In looking at the conference, Alex, what are some of the major trends that featured there?
Robotics was a huge part of it. So there were a lot of discussion about how the robotics sector was really changing businesses and I guess the profitability of some of these robotics sort of companies. The leader in that space, again, Asia company coming out of Japan, has had tremendous sort of penetration. They've always loved their robots, you know, the cute little ones that you see. So it's no surprise they've been working on that story for 15, 20 years, if not longer. Other areas though, and I guess being centered around Hong Kong, was just the opportunities with China tech. If I give you an example, retail sales in the US online represents about 10% of total turnover. In China, it's as high as 30%. And I guess their ability to really capture not just China, but Asia. And the US has had tremendous difficulty in understanding the psyche with, I guess, that culture and their ability to get the penetration very rapidly. China and the China tech companies have been able to penetrate that market quite easily. We've also seen, I guess, that development curve around private equity. And it's something as a theme we've sort of looked and said, how do we sort of explore that idea? I mentioned about potentially the number of deals possibly that we've been seeing in terms of acquisitions by Google, by Tencent, by SoftBank. And so from that standpoint, it's looking at that deal flow and saying, how do we look at trying to create some investment opportunities around that too. I think the other surprising thing that really, you know, as a firm, we've always had an interest in the space of what we call ESG, which is sort of investing for the benefit of society and, you know, the environment. And we always have had that as a gentle overlay with our portfolios. It was very front and center in terms of the investment community. There wasn't a session that didn't go on around what is the ESG implications, which was quite surprising because in Australia, it's gaining some traction, but in terms of areas like Europe and the US in particular, 2 or 3 years ago, those sort of questions, and I hate to say it, they're probably scoffed at. This time round, we saw, particularly a lot of questioning around these types of investments.
At the conference, I believe Daniel Kahneman, a Nobel Prize winner for economics from Princeton University, provided some interesting insights on decision-making. Can you share those with us?
It was really insightful. So his premise was to make a high-quality decision internally, you actually may not do it with yourself. He said that collaborative approach allows you to test something. Now, something simple like, do I buy bread and milk? We're not talking about those but those complex. So he was very much around the thinking of surrounding yourself with high quality sort of people that can help you discuss that decision. Now, as part of that process, though, he actually said you needed a person that cared for you dearly, but wasn't afraid to hurt your feelings. And he said that combination is incredibly powerful because they don't have the buy-in enough that if they tell you what you don't want to hear, but equally they obviously have a deep, thoughtfulness around your general well-being and making a good decision.
Now, I'm told that this person who was famously characterised in the movie The Big Short, Steve Eisman, also spoke. What was his take on the markets and where they're headed?
Yeah, this guy's a real propeller head, socially so awkward to sort of watch. He's really struggling with some of those skills. So Steve's claim to fame, if you haven't seen the movie, is he shorted, which is called profiting on the banking collapse. He said in his presentation in the 90s, he actually witnessed the first sort of subprime meltdown. And he said when 2007 came around, for him, it was just a repeat of what transpired. And so Steve's question that was asked of him was really around, does he see financial risk in the US markets? And he responded very clearly that at this stage, he did not see any financial stress with the financial providers in the present market in the US. So in terms of a repeat of a subprime meltdown, his answer was really no. He didn't see those sort of alarm bells. I'll go on to say, though, what's really interesting, whether it's Steve or some of these other individuals that have had a history of making these huge claim to fame calls, their ability to repeat that is quite challenging. So they get it once. It's sort of, I guess it's like a pop star, they have the one hit wonder, but the ability to be a U2 artist, for example, that can ring number of smash hits is quite challenging. And so Steve sort of wasn't alarmed at all by the current financial position of the global markets and didn't see any imminent downside risk as well, which is interesting.
Thank you so much for giving us your insights about that. And that really brings us the close to this special feature. The advice provided on this program is general advice only. It has been prepared without taking into account your objectives, financial situation, or needs. So before acting on this advice, you should consider the appropriateness of the advice and consult a finance professional. If any products are detailed on this program, you should obtain a product disclosure statement relating to the products and consider its contents before making any decisions. Where quoted, past performance is not indicative of future performance.